Hi, this is Randy Finney with the Right Side of the Chart, and this is a post-market update for Tuesday, October 25th, 2022. It's 4:18 p.m. Eastern Time, so two down and three more to go. We had of the FAANG stocks, we had Alphabet today and Microsoft. So Alphabet, of course, Google's parent company, down almost about 4%. Nothing huge, but again, a down. They missed on pretty much all metrics. Microsoft beat on earnings, but I think a little slow on cloud, Azure cloud storage. Either way, what it does here. Now, let me back up. Let me first caution. I always say don't read too much into the initial knee-jerk reaction in earnings. I've seen time and time again. In fact, you can almost count on it. It's not guaranteed, but the initial reaction quite often isn't the one that sticks. But this time, let's just talk about this or look at it this way. Okay, of those big market-moving FAANGs, and again, they're all reporting this week. You have Meta tomorrow, and then Amazon and Apple on Thursday. All of them after the close. It does set the tone a little bit because you see Alphabet getting whacked pretty hard, and Microsoft now actually Microsoft was almost back to flat, but also drifting down. And it's just going to set the stage for some nervousness, especially if these losses stick or get built upon. So we'll see what they say on the calls. We'll see how the market, how these stocks trade tomorrow when all the starters step onto the field. At 9:30 p.m. That's when the big institutions really come in with full force. All the volumes in the market, all the players are on the field. But let's just look at the technicals for what they are. So this is that little 5-minute wedge I told you this morning. Looking for a fade back to at least the bottom of the wedge, but it is a bearish rising wedge, and it shows through on the 60-minute chart. I showed it on both time frames today. This is the 10-minute chart. I showed it at the very end of the video. And so you can see since the video, the divergence even steepened. In other words, this was our divergence line here, but then the slope of that line started to steepen on that last marginal new high, and now boom, here we go. So this is good support. I have an order to cover. Let me just make sure I've got all shares. I might reverse and pop it real quick. I'm going to pause the video here one sec. Okay, just had to clean up that order just a little bit. We got 11,535, so right about, just it's probably overshoot that trend line a hair and bounce. I wanted an order to cover 2/3 of my shares right here, and I'm going to let the other 2/3 ride. Why? I'm sorry, the other 1/3. It's fuzzy math there. Because this is a bearish rising wedge. That's good support. Again, good chance they're going to step in, at least buy a little bounce, and maybe I can recycle back in. But once that goes, and again, that's a 10-minute chart. Let me show it to you on the 5. The 10-minute chart's really the realm of the active trader. This is the 60-minute chart here, and you can see the same wedge. Let me go back out a little farther, 2 months. You've got let me go back further. This is 3 months. This is where I'm usually looking on the 60-minute time frame. So a lot happened today. Here's that primary downtrend line, at least the downtrend line off the mid-August highs. There's second reaction here. Of course, the initial reaction, and now another one today. So to the button. And in that video, I said, we could carry a little higher to that level because you had ES resistance at the same time, but that was the first resistance on the NQs. And so I wanted to just point out, there's that wedge. Let me tighten it up a little bit. So you wedged right up to the trend line there, meaning bearish rising wedge pattern. And now we're at support right now, 540. It's about 541, give or take. Price support plus uptrend line support, but with negative divergence. And so this wedge looks ripe. What I mean by ripe, well, you usually break down somewhere around roughly, give or take, 70% to the apex of the wedge. You don't break down at the apex. It's rarely where a wedge breaks down. It's usually the sweet spot's about here. So if it breaks down, then that's going to be bearish. Like I said, probably get at least a minor reaction first, but enough that I'll leave a little bit on for now, because so far that's setting the tone. I think you're going to see some nervousness now. This rally kind of got ahead of itself. And then something I didn't show you today, these videos go long enough, and I a lot of times I have my notes, what I want to cover, and then other times I'll ad-lib the videos or some of the stuff. But I wanted to show you some other charts of these market leaders. It's been a pretty healthy rally off the lows. But when you look at this is showing you, forget about that little white line. I'm going to turn that off. Sometimes you just get these wonky candles. That skinny part, that's not really what happened today. You can just erase that move. Here, let me do this. I'll turn off the post-market. Regular hours. Okay, so this is what Apple did today. So you had it rally up to resistance, not huge resistance, but there's a gap right there, and it's also a level, a line I've had there for a while, about 151.50 or so. You got a little minor trend line here. And again, Apple doesn't report until Thursday after the close, along with Amazon. And by then, we're going to have the FAAMGs out of the way. It's been a pretty healthy run up. And so again, probably a good time for some profit taking. There's support on the daily chart, or resistance, I should say, around where we are. I know that's a messy chart, but what I wanted to show you too are some of the longest term charts. This is Apple right here. Here's a long term. This is a monthly chart. We're going all the way back to the year 2000, early 03 right there. That was the end. This was the great bear market from March of 2000 when the dot-com bubble burst, all the way down into the lows, and where Apple bottomed in 03. The market bottomed in 02, but Apple kind of just really held a bottom there around that time and then started taking off. So there's that trend line. And you can see we're coming up to it, and that is what we call a secular bull market. And a secular bull market is a larger bull. Within that, you have cyclical bull and bear markets. So you can see here when I flip over to a different board, that bear market from 2000 to 03 was an 83% drop. 42, 62, 45, 34, 39. This I covered today. So those are cyclical bear markets within the larger secular bear. And but the takeaway now, because I keep talking about how I think this is going to be a much different bear market than those that most of us have lived through, at least in our adult life, and a lot of you listen to my voice in your entire life. The last pretty prolonged bear market was back from, in the late 60s to the mid 70s, and since then, including this one back in 2000 to 2003 and the 07 to 09, they weren't that long in time. Apple went a little longer than the market, but they were about 2 years to a year and a half. And COVID, of course, was probably the fastest, if you want to call it a bear market, on history, because the Fed didn't allow it to last more than 6 weeks before they decided that they have the power to make stocks go up forever by continuing to print money. The newly discovered power. You just print more and more each time, take rates lower and lower each time, do they realize, I guess Milton Friedman was right. In Economics 101, you print money, you're going to get inflation. So it took the excessive money printing to finally let that genie out of the bottle, and we know where we're at. So therefore, as rates climb in the coming years, and there'll be abatements where interest rates pull back and bonds rally, and then you get another leg up. Same with commodities. I think that's a new bull. I made a case quite a bit over the last year or so that we've entered a new bull market in commodities, and so that's going to keep the inflation trade roaring for some time and keep rates going up for some time. But there it is. So the takeaway that I wanted to show you guys these are what happens if this bullish setup, again, I keep talking about the bullish setup on the daily and weekly time frames being some of the most bullish setups I've seen in years. If they fail to materialize, just like they did back at this point in the bear market back in 2008, the last real bear market, if they fail to materialize, the only difference between now and then was 2008 was just a cyclical bear market, well above trend. It was right here, 2008, right there. And Apple, took it on the chin, as did most growth companies. Apple dropped 62% back then, but all it did was just if you will, a corrective phase within an ongoing larger bull market. So, and I can go over here. I'll do it real quick. I'll go over some of the top components of QQQ. There's Apple, their primary uptrend line. Here's Microsoft right here, also reported tonight. There's one trend line, and here's another that comes this is a pretty significant one off 2015 low right there. And Microsoft has already taken out that trend line. And by the way, guys, they're all, like I've covered many times, they're all below that big, or to me, very important 20-week I'm sorry, 20 period monthly exponential moving average. So on the monthly chart, the 20 period, and that often delineates bull and bear markets. And Apple again has had those bear markets, and each one of those, I already showed you the drops before. These were all bear markets. The only time it's ever gone below those numbers, this moving average, is right here when you had these bear markets that I just showed you right there. And we are again. Well, this one's flirting with it. Apple's the last holdout, if you will, of the FAANGs. Obviously, we all know it commands it's the largest of all those by market cap because it's a great company. They sell great products. Everybody loves their iPhones and their iGadgets, and they've got a great business model. But as this chart shows you, they're not immune to bear markets. When the economy falls and the market shifts from risk on to risk off, Apple gets dragged down with the rest of the lot, kicking and screaming. It's almost an immutable fact. You're not going to see Apple rise and go to new highs if Amazon and Microsoft and Meta and Alphabet all go down 30, 40, 50% over the next or through the cycle of this bear market. So I just want to point out the trend lines, and then here you are. Here's a monthly right here from late 2018, that major low. We're flirting with that level. We have 1, 2, 3 reactions. So a lot of these stocks, even though you have that very bullish setup on the daily and weekly, they're flirting with key support levels. There's Microsoft already below, Alphabet. Look at this trend line here. Alphabet, remember FKA, formerly known as Google, changed their name to Alphabet somewhere, but this is where they went public in '04. That's their entire history. They're publicly traded as a publicly traded company, and it's a well-defined bull market uptrend line, a secular bull market, and within there's been plenty of corrections that were very, very much bear markets measured by the drop, and it just brought you back to the mean. It was a return to the mean, back to the trend line. And hey, if you have bull goggles on and you think this economy and the stock market's got a lot to go, you buy with both fists here. You've bought every other time that we came back to that level. You were rewarded with triple-digit returns, and you could do it again here. Or you might say, well, sooner or later, all trend lines break, all bull markets end, whether they're cyclical or secular, and just things to keep an eye on. That's all. And so it's pretty much, if we have a really ugly month and we smash down to my next targets on the weekly chart and park there and don't rally quickly by the end of the month, you could close and get a sell signal on the all-powerful monthly time frames here. So we've got well, I'll tell you what, today, it's weird. Today's the 25th, so really we're almost at the end of the trading month, so we'd probably not get a clear sell signal on those at best until next month would be my guess, but we'll see. Anyway, I just wanted to show you all these levels here. There's Amazon. Look at Amazon. Amazon went public back in '97 right here. And just look at the beauty of this trend line, how well defined their secular bull market trend line is. I have two. I have an alternative trend line that's already been taken out. That was my preferred trend line in yellow. It had 1, 2, 3, 4. You had reactions there, several here. Another one right here. That was when COVID hit, that little blip, but it touched it perfectly. That's been taken out. However, you know me, I like to make a lot of things up, a lot of terms, and one of them is called BOD, or benefit of the doubt trend line. Why? Because that one comes in and captures this little spike through there, so you have fewer reactions, but it comes in and captures all those lows, and we've been dancing on that. So if and when that goes, then that's just lights out, because you're already below the 20-month. And again, look how well that 20-month works. Remember, it's a monthly chart, so all that matters is how you close the month. Those skinny parts, those are just intra-month moves through. Look at all those reactions. Act as support, support, support. It was support back here, big drop in 2016. It was support for all these. This was about a year. Every single month, you dip below it only to rally and close back on or above it again. Look at that. The last time that Amazon had a solid monthly close and went below there was all the way back in the last real bear market, the 2007 to 2009 bear market. And I was trying to zoom in, if I can grab the little thing on the bottom. There it is. right there. So there it is, 2008. Boom. See, we're dancing, dancing. It was support, 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 support. You gave up the ghost there. That's when that divergence failed to play out. That this comparable bullish divergence on the daily and weekly charts back then, and the bottom fell out, and then it was a quick swoon down, and you had a solid red candlestick print below that, again below, and at this point it told you, hey, bear market's over. Get back in the game. And if you had just used this one single indicator, you would have never been shaken out of your Amazon, anything other than a brief whipsaw, and get back in there. But look, we're below it. So that's what I'm saying. Right now, there's cross currents. On one hand, you have BOD support, and maybe we rally. But on the other hand, you have resistance, some big levels, including things such as, but not limited to, this 20-period exponential monthly average there. There's the other alphabet share class. Just nice, you can see it here, just a nice clean, there it is, nice clean uptrend line, flirting with it now. And then Tesla, who already reported, but look at Tesla sitting on a shelf of support. I mean, if that's not good support, I don't know what is. That's 205, by the way, that level. Just look at how many single candlesticks, how many consecutive candlesticks, I mean, and then more here. Tag that level. I look at support. I look at the most number of reactions, either the bodies, the fat part, or the shadows, and the wicks underneath here in this case. So what you want to look for is, you get a solid monthly close below that level. That's going to be bearish for Tesla. All right, so that's it. Let me show you one other thing here. Okay, again, so we're not going to read too much into this now. We'll see how things shape out tomorrow. You do have, here, let me turn back on the after hours trades, include post-market. So you can see, remember in the video I talked about today, big resistance right there. And so far with earnings, it was a failure to pop. In fact, it was a perfect test right there today on the right before the market closed. Perfect test of that 105 resistance and a rejection. It's not over. It's just like the stock market. Bears win if they can take out the recent lows. Bulls win now if they can take out the recent highs, because that's going to pop you back into this trading range. That 105, as I said earlier today, wasn't just the bottom of that trading range. It was the top of this trading range back here, all the way back in early 2021. We had a month, 2 or 3 month, about a 3-month period of consolidation there after the the COVID correction, if you want to call it, was over. We stair-stepped our way up. That's how Alphabet worked. We had these little periods of consolidation, and when we break to the upside, that's bullish. You come in a back test, another level of consolidation, gap up, another level of consolidation, breakout, and then a trend for a while, then a bigger level of consolidation with support there, and then you broke down, you back tested from above, that became resistance. You bounced around for most of the year and recently broke it, and now rejected. So what you want to watch for in the coming days to weeks really is this is now our trading range in here. It can extend for a while, or it could break down or out to the upside any day now. So bulls win if they break to the upside, and bears win if they break to the downside. Okay, so sometimes you can get a little intraday whip or even a 1 or 2 day breakdown, and if it happens, just take it on face value. That's what usually, unless I suspect otherwise, you can short it and look, and then if you short it and you see you got back solidly inside the range, and cover your short. And likewise, if you go long on a breakout above there, and if it fails, give it a little bit of room, maybe a day or two. But if you start moving back down well inside the range, then you're probably going to go back to the bottom. All right, and that's just one of many stocks, but like I said, 2 out of the 5 out of the way, 2 of the 5 FAANGs out of the way today, both trading down and after hours. Nothing huge, again, relatively speaking. This is a big red candle, down about 4%, but that's par for the course with this elevated volatility. So most important takeaways is let's just watch the rest of them. Tomorrow we'll see Meta, and then Apple and Amazon on Thursday. Of course, both of those after the market closes. As of now, really nothing's been foiled on QQQ. It's a little pullback off the highs today, but you're still well above the lows. And they're either going to, in the coming days to weeks, they're either going to build on those gains and run up to those potential upside targets I gave you, or Apple, and mainly Apple and Amazon. Those are going to be the big two. Meta's not really moving the needle as much as it used to anymore. It's only, when I say only, but it's only a $351 billion company now. That compares to 2.4 trillion with Apple, 1.8 trillion with Microsoft. So, remember the S&P 500, Nasdaq 100 are cap-weighted indexes. So, what that means is Meta could be down 10% on the day, and it won't even have the same effect on the index as if Apple or Amazon or Microsoft go up, 3, let's say, or somewhere, wherever that math works. All right, I'm going to wrap it up here and get the video out to you guys, and just watch that 60-minute chart. Oh, look at what we have here too, potentially. Remember, I've been highlighting these bearish PPO crossovers right there, right there, right there, right here most recently, and get a pullback. It was nothing big, but we'd get a pullback, and then made a bullish cross. It was called a whipsaw if you want. You can call it a signal that played out if you want, because there was a nice tradable pullback. But should we follow through to the downside tomorrow, and again, I have to keep saying this, whipsaws are almost to be expected now, so we can get that sell signal. It's going to be bearish, but then Apple and Amazon have the potential to either make it a whipsaw or to confirm it and solidify it, and then get another big leg down. And then at that point, well, we'll see. Let's take it day by day, minute by minute. There's an uptrend line right there that's been broken. I guess that's that same wedge I gave you right there on the 60-minute chart of the futures. Let me see. No, that one we should be right at the wedge. There we are. We just hit it. See, we just hit my pullback target right there. 541 right there, and the uptrend line. So again, the nature of this wedge, the PPO is rolling down. It's probably going to break down, and if it does, you can see where the targets are. All right, let me get the video out to you, and we'll pick it up tomorrow. See how the market trades during the regular session tomorrow. How it trades tomorrow night after Meta, how it trades Thursday night after Apple and Amazon. Then we'll have a good idea, I think, even though we've still got the Fed on Wednesday. If the market doesn't like what Apple and Amazon are selling, then that's going to increase the odds that this whole bullish setup is not going to play out for anything more than the 10% or so rally that we've already gotten. We'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great evening.